Okay, so we begin with November 2019, question number 4. Bedline Limited is a manufacturing division of a large industrial company. As Wafula, the division manager, is about to purchase a new plant to manufacture a new product. Asrop could either purchase an automatic plant or manual plant, each of which has the same capacity and expected useful life of 4 years. The two machines, however, differ in their expected capital cost and cash flows as shown below. So we have those items. Then in the above calculation, it is assumed that each plant will be installed and paid for at the beginning of year 1, and the net cash flows occur at the end of each year. Neither of the plant is expected to have a residual value. Like all other division managers in the company, Asrop Wafula is expected to generate before tax return on his divisional investment in excess of 16% per annum, which is currently just managing to achieve. Anything less than 16% returns would make him ineligible for a bonus and might reduce his pension benefit when he retires early in year 3. Then, in calculating divisional returns, divisional assets are valued at net book value at the beginning of the year. Depreciation is charged on a straight-line basis. So using appropriate computations justify why neither return on investments nor residual income would motivate Wafula to invest in the machine with the higher net present value. So that is what we are supposed to deal with. A minute. So that question of November 2019 November 2019, question 4B is on performance measurement. It's on performance measurement. And in this one, we have the big column of details. So the project, we are told, is going to be there for 4 years. So this is year 1, year 2, this is year 3, this is year 4. This is year 4. The projects, the first one is called auto. Then we have manual, auto, manual, auto, manual, auto, and manual. Auto and manual. So with that, we are supposed now to bring opening book value, which we will call A, with less depreciation, which we will call B. Then we will have closing book value, which will be arrived at A minus B. That is how we are going to arrive at it. A minus B. Hata tunaweza ifungia hivyo. So what you can see is that the first project has a beginning value of 9,600. Beginning value of 9,600. So what you do with that is you record 9600 here. Then you divide by 4. So divide that by 4. 9600, when you divide by 4, what are you getting? 9600 when you divide by 4. Give me the figure. Yes, Josephine, I can see 2400. So that 2400 will be the depreciation for that plant every year. So when you say 9600 minus 2400, the closing balance is 7200. That becomes the opening balance the second year. You less 2400 again. You record 4800. That becomes the opening balance for that year. You less that, you get 4800. Then you have 4800. You get 2400. You get 2400. So that 2400 to open here, and then you less 2400, you get a 0. You get a 0. Okay, let's do the same thing for the next one. Let us do the same thing for the next one, which is having 7800 as the opening value here. So 7800 divided by 4, what is the answer? What is the answer? Yeah, good, 1950. So we have 1950. So if you say 7800 minus 1950, I'm getting 5850. Then 5850, you less 1950. You less 1950. That gives you that 900. That opens the third year. You less 1950. You less 1950. You are left with 1950. Then 1950, you less 1950. You get 0. You get 0. You get 0. Right, let us now compute something called cost of capital. Cost of capital. Now, cost of capital, according to this question, we are told it is 16%. The cost of capital is 16%. So we will talk of 0.16A and we call it C. 0.16A and we call it C. So what we shall do for the first one, it is going to be 0.16 of 9600. This is 15.6. 0.16 of 7800 is 1248. 0.16 of 7200 is 1152. 0.16 of 5850 is 9.6. 0.16 of 4800 is 768. 0.16 of 3900 is 624.16 of 2400 is 384.16 of 1950 is 312. 312. The next thing that you need to do is to bring the net cash flow. Net cash flow, and we call it B. So the net cash flow is as provided in the question. The first project has that 600. It has that 600 every year. That 600. That 600. The second project, it's on that 900, followed by that 300, followed by 2250 and 1500. So those ones you just copy as they have been provided there. As they have been provided. As they have been provided. So hata hizo naweza fungia. The next thing that I need is income. Now, income will be given as D minus B, and you can call it E. D minus B, and you call it E. So, itakuwa that 600 minus 2400. Itakuwa constant for the first project. For the first project, it will be constant. For the first project, it will be constant. So the next project is the same as that 900 minus 1950. I get 1950. That 300 minus 1950. I get that 1050. 2250 minus 1950. I get 300. And then 1500 minus 1950, I get minus 450. Minus 450. Then from there, I need to get now something that we call residual income. Something that we call residual income. Residual income. Now, residual income is supposed to be given as E minus the cost of capital, minus C. So E minus C, that will give me my residual income. E minus A, minus C. So we begin. So I have 1200 minus 1536. That is minus 336. Then 1950 minus 1248 is 702. 1200 minus 1152 is 48. 1350 minus 936 is 414. 1200 minus 768 is 432. 432 is 432. Then 300 minus 624 is minus 324. 1200 minus 384 is 816 minus 450 minus 312 is minus 762. And then finally, we need to get something called return on investment. Return on investment. And this return on investment should be given as E. You divide by A, you multiply by 100. E, you divide by A, you multiply by 100. So when I start with the first one, I'm taking E, 1200 divided by 9600 times 100 is 12.5%. 1950 divided by 7800 times 100 is 25%. Alafu 1200 divided by 7200 times 100 is, let me call it 17%. Then 1350 divided by 5850 times 100, let me call it 23%. Then 1200 divided by 48 times 100, this is 25%. 300 divided by 3900 times 100, let me call it 7%. Then, 8%. That should be called 8%, going by the roundings. Then 1200, I divide by 2400 is 50%. And then minus 450, you divide by 1950 times 100, I call it minus 23%. Minus 23%. So are we in agreement at that point? If you agree with my workings, say my yes at that point. Good. Can see the yeses. That's good. The next thing that you need to do is to come up with averages. Is to come up with averages. So I can still continue down there. So the averages, so for the averages, I have the measure here. I start with the residual income. Residual income. And then I have return on investment. Return on investment. Return on investment. Let me start with automatic plans. So for the automatic plans, the residual income will be minus 336 plus 48 plus 432 plus 816. Now this one we divide by 4. We divide by 4. So I'll say minus 336 plus 48 plus 432 plus 816 equals, divide by 4, I'm getting 240. I'm getting 240. Then I come to the manual branch. When I get to the manual branch, I dance the same rhythm. I get 702 plus 414 plus minus 324 plus minus 762. You divide by 4. So 702 plus 414 minus 324 minus 762 equals, divide by 4. This is giving us 7.5. 7.5. Let's do the same thing with this other one, so that I have 12.5 plus 17 plus 25 plus 15. I divide by 4. So 12.5 plus 17 plus 25 plus 15, divide by 4. That is giving me 26.125%. Then this other one has 25 plus 23 plus 8 plus minus 23. You divide by 4. And then that must be 25 plus 8. You divide by 4. 8.25%. We have 8.25%. So Felix, I would like to know your second name. Use your second name, the two names. Send me your second name, or you change in your whatever. So if we are okay with that, then we can proceed to answer the question, which was saying, using appropriate computations, justify why neither return on investments nor residual income would motivate Asrop Wafula to invest in the machine with a higher net present value. So if you go back to information or to what we are told in the table above, you can see which plant has the higher NPV. Which plant has the higher NPV? Which plant has the higher NPV? Yes, it is the automatic one. Is the automatic one. Good. So if it is the automatic one, good, you can see. You can see at the beginning of the period, automatic, here it has recorded a negative, while this one has a positive. It has 12% return, while this one has 25%. So Wafula would be more encouraged to go for the manual, because here it has a very high value, 702, and a double of the return. Look at the second year. Second year, automatic has 48, while this one has 414. So it is still below. It has 17, while this one has 23. So even second year, you will still be encouraged to go for this. Come to the third year, that's now when tables change. That's when tables change. This one now has 432, this one has 324, these are 25 and 8. But looking at the averages, if because things must be done at the beginning, then the next time we compare notes is at the end. So at the beginning, he will prefer this one. Then we go all the way now to the fourth year, beginning of the fifth year, that's when we compare notes. So comparing notes, you find that the plant which he preferred manual at the beginning of the first year, it ends up with just a paltry 7.5, or the other one would have been 240. It ends up with 8.2, while this one has 26. Now, why do you think Asrop would be encouraged? He would be encouraged to go for manual. It is because of what the question says in information number 3. That these guys, they have a bonus scheme. And in that bonus scheme, you must not have anything less than 16%. So you see this one, it is below 16% for the first year. This one, it is slightly past 16%. And remember, it was actually even rounded up. It was 16 point something. So he has just met the benchmark. So he does not qualify for any bonus. But going by the manual, you can see here he's way above. Even here, he's way above 16. He's way above 16. The only time that he will now miss when he goes by manual is the third year. So in the period of 3 years, when he goes for the automatic, he will only get a bonus in 1 year, that year. But if he goes for the manual, he will get bonus for 2 years. So tell me, if you are the one, would you want the plant giving you a bonus for 1 year or 2 years? Let me see. Kama ni wewe, ukendea project yenye inakupea bonus 2 years ama 1 year. Yes, good. I can see the answers coming very fast. You would go for 2 years. So that is the reason why. Yeah. So that is the reason why he will reject. He will reject the plant with the higher NPV. He will reject the plant with the higher NPV because it only makes him to earn bonus 1 year in 3 years. It only makes him to earn a bonus in 1 year in a period of 3 years. Higher. So advise on what should be done. Advise on what should be done. Yeah, good. Jared is also pointing out that he will retire at the beginning of the 3rd year. So actually the idea does not even count. The idea then does not even count. The idea does not even count because he's retiring at the beginning of the 3rd year. So if he goes for the automatic, he will get no bonus. But if he goes for the manual, he will get a bonus for the 2 years. And everyone would want to go home with something. No one would want to retire when they have nothing. Now, what remedies should be done? If you take the handout that I gave you that has dysfunctional consequences, can you check whether you can see them? The handout on performance, where we discuss performance measurement. There is somewhere we called dysfunctional consequences of short-term measures. If you can see them, say my yes, I'm a type C. We are able to see where those values are type C. Yeah, Jero has seen them. The others, have you seen them? How many are they, those who have seen them? The remedies. How many are they? There are 3. Good, good. So those are the ones that you will copy. Those are the ones that you copy. One is prolong the measurement period. The other one is you improve on the accounting measures. And number 3, you use non-financial measures. So copy them from there as they are. So that with that now, I am in a position to proceed to question 5A. Question 5A. Variance Fitness Limited specializes in the manufacture of a small range of high-tech products for the fitness market. They are currently considering the development of a new type of fitness monitor, which would be the first of its kind in the market. It will take 1 year to develop, with sales then commencing at the beginning of the 2nd year. The product is expected to have a life cycle of 2 years before it is replaced with a technologically superior product. The following cost estimates have been made. So we are given all that, and we are told to ignore time value of money and then get what we call the life cycle cost per unit. 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 So that question has come from life cycle costing method. Life cycle costing method. And in that, we are going to prepare a table that will have something like this. We have details, we have units, produced and sold, produced and sold, we will have units which are produced and sold. Then here we will have now to bring the costs. We bring the costs. So the costs which are there, we have research. We have research. We have design. We have marketing. We have manufacturing. At this manufacturing, first of all, we have the variable. And then we have fixed. Then we do have distribution. Distribution, we have variable. And then we have fixed. Then we have selling. Selling again, we have variable. And then we have fixed. Then we have total. We have total. So we can work with our figures in millions. So here we will have the workings. We'll have the workings. And for me to be guided by, to know where my table will get to, let me start with the one that has the longest working. The longest working, this one of manufacturing. Manufacturing variable, it will be 40,000 times 100,000 units plus 42,000 times 200,000 units. Yeah, I think that tells me where my figures will get to. Sorry, this one I should not have called it workings. Let me leave it that way because the workings should have been here. And these ones are the amounts or the answers. So with that now, I'm able to estimate what I require. So with that now, I can come back here and say, for the units produced, I have 100,000. I will add the 200,000, and that will give me 300,000. Those are units. Now for research, maybe I can still come back here. Now that this one is not in millions, I can still come back here and confirm that this one is shillings in millions. So that nikikuja kwa research I just have 160. That one does not have a working. So I just have 160. That way. Design, I just have 800. Just have 800. Marketing, I will need to get 1,200 plus 1,000 plus 1,750. So give me that figure. Give me that figure when you add this one for marketing. That 950 gets that 950. Let us come now to this one. Multiply and give me now in terms of millions. Multiply and give me in terms of millions. Multiply this one for marketing. I'm waiting for the answer. $12,400,000. That is according to Timothy. The others, ensure you are also confirming. Yeah, Ibrahim confirms. Good. Let's go to the manufacturing. For the manufacturing, the fixed we have 650. You add 1290. You add 1290. So 650 plus 1290 is what? 650 plus 1290 is what? $19.40. So I bring $19.40 there. Then we go to distribution. Distribution, the variable, I will say 4,000 times 100,000 units plus 4,500 times 200,000 units. Waiting for the answer. 1,300. For the fixed distribution, it is 120 plus 120. At least that one I can help you is 240. We go to selling. Variable is 3,000. 3,000 times 100,000 plus that 200 times 200,000 times 200,000. Mm-hmm. 940. Let us go to fixed. Fixed, I have, that is for the selling. Oh, now that I forgot to include admin, uja hapa useme selling and admin. Ongeza hivyo selling and admin so that I combine them here this way. For the selling, 180 plus 180, those are the sellings. Then I bring the admin 200 plus 900 plus 1,500. Yeah. Let us put them that way. Now that I forgot to include the admin, we can combine them, selling and administration. Add all of them and give me the answer. $29.60. $29.60. Now give me the total. Get the total now. Kutoka huko juu. Give me the total now. Give me the total of those costs. So that we'll be able to say unit life cycle costs. Unit life cycle costs 24,700,000. So we take it back. So this one you divide by all the units, 300,000. You divide by the units. $24,690. 24,690. Good. 24,000. Which is which now? Was this the total cost? Ibrahim and Emmanuel, you seem to have different figures. 24,690. Oh, this is the total. Oh, okay, okay. So the total is 24,690, which I'm 690 million, which I'm supposed to divide by 300,000. Okay, so unit cycle cost is 82,300. Is that okay now? Yeah, I can see now people are agreeing on that. So if we are okay, let's now close to part B of the question. Part B of the question. Nilo Limited is one of the largest and most diversified textile farms in the country. Just a minute. As a minute, I get something. Okay. The company manufactures and sells its products through 25 individual divisions that operate more or less like autonomous companies. Each division of the company has its own manufacturing plants for making the division's product, a sales team and admin staff to provide financial assistance and control. Broad policy and financial guidance, as well as technical assistance, is provided from the head office of the company. Nero Limited uses several measures to determine divisional performance. However, the most widely used measure is the return on investment of each division. The following information relates to determination of return on investment of all the divisions. Number one, the returns of each division of each investment of a division is determined using the following formula. We have return is equals to divisional revenues, that is sales to outsiders and insiders, you less direct divisional costs, you less allocated central corporate costs. The investment of a division is determined as follows. Investment is equals to book value of assets. Book value of assets is the aggregate of the accounts receivable, net of accounts payable, inventories including raw materials, work in progress, and finished goods and long-term assets, net of accumulated depreciation. The actual return on investment is calculated monthly for each division, and the formula is uniform across all divisions as it is centrally determined. In undertaking performance evaluation, emphasis is laid on threats rather than absolute goals and standards. The management also lays emphasis on divisions whose performance is improving or deteriorating and has set a minimum expected return on investment below which the manager is required to face disciplinary action. This minimum return on investment is, however, loosely set, hence easily achievable. The minimum return on investment is determined by applying different weights to the three investment components as follows: 20% of depreciable assets, 12% for inventories, and 6% for accounts receivables. Transfer prices between divisions are negotiated between themselves. Now discuss three strengths and three weaknesses of the return on investment measure as used by Nero Limited. So that question is coming from performance measurement. It's coming from performance measurement, and specifically the financials, which is the return on investment. Now, when you are told to discuss the strengths and the weaknesses, as in this case, you are not discussing the strengths and weaknesses of ROI as a general measure, but the way it is being used in this company. So we are going to focus on how this company in particular is going about it. So let's start by strengths. Look at strengths. What are some of the things they are doing well? Strengths. So point number one, I'm going to read as you write. Point number one of the strength is use of book value as a measure of investment. Use of book value as a measure of investment. Use of book value as a measure of investment, which has excluded items within control items beyond control, not within, items beyond control of the managers. Beyond control of the managers. Now that one you can see it in information 1. If you look at information 1, you can see they have excluded the allocated corporate costs. You can also find it in information 3. Information 3, book value is the aggregate of the accounts receivables. Net of accounts payables. Payables are beyond control. Inventories are also beyond control. So that is a major strength. Number two, you can say the formula used is uniform across all divisions. The formula used is uniform across all divisions. Is uniform across all divisions, which enhances fairness. Which enhances fairness. Which enhances fairness. Yeah, you can see that in information 4. You can see that in information 4 that the formula is uniform across all divisions as it is centrally computed. So if all of us are subjected to the same measure, then no one is justified to complain. Another strength is emphasis is laid on trends rather than absolute goals and standards. Emphasis is laid on trends rather than absolute goals and standards. That one you can get it in information 5. In information 5. What that means is absolute goal to say we wanted everyone to make this profit. That is absolute. Like the question we have handled for Afula, where we were saying this guy must hit 16%. So if you have not hit 16%, you are out of that game or you are out of that scheme. That is what we call absolute. You must hit this one. But now this company is saying, well and good, we had the 16, but let's look at your trend. Let's look at your trend. Last year, you reported 5%. This year, you have 8%. This year, or the third year, you have 14%. So in as much as you have not hit the absolute 16, you should be recognized because your trend shows that you are moving towards the target and you are moving in the right direction. Similarly, when we look at the trend, it is possible that when we began, you had 16 or you were above 16, like what we saw in the project of mine. You even recorded, for example, 30%. But come second year, you are now talking of 22%. Come the third year, you are now somewhere around 17%. Come fourth year, you are around 15%. So in as much as you have hit the absolute, you have exceeded the absolute, we should be careful or we should be mindful of the trend. You are going downward as time goes by. So that is a major strength, that we are not just looking at the absolute, but we are also looking at the trend. The other thing is transfer prices are negotiated between managers. Transfer prices are negotiated between managers. That is also a very, very important strength. Transfer prices are negotiated. That one you can find it in information 8. You can find it in information 8. We said when people negotiate, there are many benefits that accrue from that. Let's look at a few weaknesses. A few weaknesses. Number one, the inclusion of allocated central corporate costs is wrong. The inclusion of allocated central corporate costs when computing return, let's add that one. The inclusion of allocated central corporate costs when computing return is wrong. Is wrong since they are beyond control of the division. They are beyond control of the division. That one you can see it in information 1. The last item which they have subtracted, that allocated central corporate cost. You should not be blamed on what happens in the head office. You should not be judged on that. The second weakness is in information 4, where we are told the actual return is calculated monthly. So we can put it this way. Monthly ROIs are not effective. Monthly ROIs are not effective because the period is too short. Because the period is too short, to generate a significant performance. Because the period is too short to generate a significant performance. Yeah, a while ago when we began the other question, we talked of prolonging the period. So if you are measuring the performance every month, it's too short. It's too short for anything to have realized results. Something else that you can see is in information 6. The target is loosely set. The target is loosely set. The target is loosely set. So that is also a major weakness. When you have something very simple, then people do not stretch themselves and you end up getting very little. So I hope that is okay. Are you okay with those things now? We are okay, say yes, so that we move to the next agenda. Yes, Josephine. Cyrus, it's okay. Emily, Manuel, John. Okay, let's cross to the paper of May 2019. The paper of May 2019. Yes, Marin. Now, the paper of May 2019, question 1A says, highlight 4 fields in which the use of environmental management accounting is applied. That question is coming from what we have been talking about almost in every paper, issues to do with environmental management accounting. So this one, I just want to highlight quickly, you write, areas where we can mention this or we can apply the knowledge. One is product pricing. Product pricing. Another one is budgeting. Budgeting. Another one is appraising investment projects. Appraising investment projects. Another one is determination of costs. Determination of costs. Obviously, relevant costs. Determination of costs. And another one is minimizing environmental costs. Minimizing environmental costs. Minimizing environmental costs. Minimizing environmental costs. Quickly read the part B on your own. Read part B on your own as I fill my whiteboard. So that question is coming from something we call ex post variances. Ex post variances. And I told you in ex post variances, it is a situation where we want to bring on board a change in the environmental condition. A change in the environmental condition. And this ex post variance says that the conventional variance should be broken into two parts. We have what we call the planning element, and what we call the efficiency element. The efficiency element. Efficiency element. Now this planning element is beyond control. But the efficiency element is within control. Is within control. Is within control. Now take a case of fare. You are going home, maybe you are in town like me, and when you are here in class, you have an amount you expect to pay for the fare. Or maybe Let me first of all come to the conventional variance. Conventional variance is the variance that we have been computing all along. And if you remember, we have been saying it is the standard minus actual. That is what we have been doing anytime we have come across variances. Standard minus actual. So I was saying, assume you are going home and you expect to pay 50 shillings. And by the time you are thinking of this 50, you don't imagine there will be rain by the time you go home. But when it is time to go home, there is a heavy downpour. And therefore you go to the bus stop and find they are charging 80. So that gives you an adverse variance of 30. That is what you have been doing. But the expose says, these variance, remember, first of all, these variance are used in performance measurement. You'll be punished or you'll be rewarded on the ground of this one. So the exposed comes in to say, we need to incorporate the change in the environment. As in, when we were saying to ourselves, we shall pay 50, we never thought there will be rain by the time we'll be going home. We never thought there would be rain. But rain came when it was time to go home. And courtesy of that, fare changed from 50 to 80. So this one should be broken into two. This one should be broken into two. The planning and the efficiency. The planning and the efficiency. Where we will say, if we knew there would be rain, maybe we would have expected to pay 70. So when we finally went home and got 80, then we reported a variance of 10. We reported a variance of 10. So what you can see, this 30 is broken into two. There is another one of 20 here. 20 and this 10. So this 20 is the one brought by the rain and is the difference between this one. That is how we get the 20. I hope you are following that discussion. And it is in your handout, and I told you to, I even gave you a question to handle. So this 20 is the difference between the fare to Itarajia when we did not know there would be rain, and the fare we would have come up with if we knew there was rain. Then we have this 10. This 10 is the efficiency. And this is the one that you should be punished on. So in your performance report, instead of using 30, we should charge you 10. Now this 10 is the one that will be asking questions such as, wakati uliona kunanyesha, why couldn't you stay longer in the class or where you are until fare goes down? If you could not stay longer, when you walked into the streets, why couldn't you start somewhere as you wait for the rain to go down and fare to come down? If you had nowhere to start, when you go to the bus stop, why didn't you negotiate with the makanga? If you could not negotiate, or you negotiated and they never listened, why didn't you think of walking a few meters or a few kilometers? Those are things that are within control, efficiency. But rain is beyond your control. So then, how do we compute the planning. So planning element, as you can see, it is supposed to be computed as standard minus expected. The standard minus expected. Then the efficiency element is supposed to be computed as the expected minus actual. So that if you combine these two, as we are saying, planning plus the efficiency, then this goes. This 70 goes, but tunaachiwa our 50 and this one. So are we together at that point? If we are together, say okay. Cyrus is okay. Josephine is okay. Emmanuel, good. Yeah, good. We are okay. So that was the background. That was the background to the question. That was the background. Now, the other thing that you notice is in this question, there is the use of the running curves. So using running curves, so the solution now begins here. In the exam, you don't need to write, but you need to understand them because they are the ones that are going to help us. So the solution in the exam begins here. So this was a recap. And these ones are in your notes. If you have the handout I gave you, there's something called ex post variances. So using running curves, we will say that y is equal to ax raised power b plus 1. Y is equal to a bx. So quickly, b we know is given as the log of r. You divide by the log of 2. Log of r, you divide by the log of 2. So this is the log of 0.9. You divide by the log of 2, which we are already even told is minus 0.152. We are already told is minus 0.152. So b plus 1 should be minus 0.152 plus 1, and that should be 0.848. Then x, they are the units that are involved. The units that are there, they are the batches. These are the batches. There are 6 of them. There are 6 of them. Then A represents the time required for the first one. The time required for the first one. So you can see in the budget, we were planning to take 2,400 hours. And this would have been enough for 6 batches. So tell me, tell me what would be the hours per batch. Nipatie hiyo. Yeah, good. We have 400 hours. 400 hours. So the expected time Y should be 400 times 6 raised to power 0.848. 400 times 6 raised to power. So give me that. Yes, Emmanuel. Good. 1827.8. So let's make it 1828. 1828 hours. So according to the running curves, that is what we should have had as the hours. Something else that will keep on coming across is reparates. Reparates now. In the budget, you can see the budget labor cost is 1,680,000. Now this one you divide by the number of hours, 2,400. You divide by the number of hours, which are 2,400. What would be the budget rate? When you divide, good, 700 shillings. Then actual rate, you do the same thing. The actual cost is 1365,000. 1365,000. You divide by the actual hours, 1950. Now, why I'm computing these things is because I know the formulas I'm going to use, they will require these things. They will require these things. I'm waiting for that figure. It is still 700. Still 700? Okay, good. Okay, so still 700. So what the examiner wants is we should reconcile. We should reconcile the conventional. So let's start with the first one that we are given, total labor cost variance. Let's start with this one. Total labor cost variance. This is the one that we are told to break down into the two components. So if I start with the planning, as per the formula of the planning, it is the standard minus the expected. So I will say standard labor costs minus expected labor costs. Standard labor costs minus the expected labor costs. Now remember, standard and budget, they have the similarity of both are predetermined. Both are predetermined. But the difference is standard is usually first of all expressed on per unit, while budget is expressed for all the units. That means if you have the standard and you know all the units, you have the standard and you know all the units and you want to go to the budget, you simply take the standard, you multiply by the units, you go to the budget. If you have the budget and you want to go to the standard, you divide the budget by the units. And if the units are the same, then standard total and budget total are the same. If the units are the same. So in our question, the units are the same. You can see the batches, they are 6, 6. So when I write standard here, I'm also talking of the budget, because they are the same. And consequently, my standard labor cost should then be the budget cost of 1,680,000. 680,000 minus the standard, or rather the expected. The expected should be I expected to have this number of hours for the actual 1828, each being paid for at 700. Each being paid for at 700. So give me that amount. Give me that variance. $400,400. Is it favorable or adverse? Favorable or adverse? Yeah, good. It's favorable because it is positive. All right, let's come to the efficiency. Efficiency is the expected labor cost. Expected labor costs minus actual labor costs. Remember, that is the general formula I gave you for the expected. can see it here. The expected, the efficiency is the expected minus the actual. That way. So Sasa, the expected we already know. It is 1828 times 700. The actual labor cost we already know. It is 1,365,000. Give me the answer there. $85,400 advance. That is according to Gerald. Someone else to confirm. Ibrahim says, okay, good. So the conventional is supposed to be, I will not compute because it's already computed for us in the normal way. Eh? Here, kusema standard minus actual. He minus this one. Eh? I will not. I want to reconcile this one. Such that when you be a 400 favorable plus 85,400 adverse, it is equal to what? It is equal to what? $315,000 favorable. And you can see that is the one the examiner has given. $315,000 favorable. So that is what the examiner wanted you to do. To show that the conventional is the planning plus the efficiency. And let's go quickly to the next one. We break the next one in the same way. The next one he has given is labor rate variance. Labor rate variance. So for the labor rate variance, for us to get the planning, we will, remember we always start with the standard rate. So we are going to open the brackets here and talk of standard rate minus expected rate, you multiply by actual hours, and that gives you the planning. That gives you the planning element. That gives you the planning element. That gives you the planning element. So the standard rate ni hii budget, which is 700, minus the expected rate. The expected rate is this one of actual 18, not 18, it's 16. That's the expected rate, which is 1680. You divide by 1828. As in, if we knew this would be the hours and this would be the cost, then the difference is what would have paid. Multiplied by the actual hours of 1950. Give me the answer. $427, 123. 427, 123 adverse. Adverse. Good. Let us go to the efficiency, which we are going to say it is the expected rate. The expected rate minus actual rate. Actual rate multiplied by actual hours. Multiplied by actual hours. And this will give you the efficiency. That will give you the efficiency. So, sasa hii itakuwa 16,800. You divide first by 1828. Then you minus the actual rate. Tulikuwa nayo hapa 700. Multiply by 1950. And because you can see inafanana na hii, you can see inafanana, the only difference is the sign. That tells you it will be 427, 123 favorable. 427, 123 favorable. And proceeding, if I now come and say planning plus the efficiency should give me the conventional. Should give me the conventional. I will take 427, 123 adverse. Plus 427, 123 favorable, and it is 0. And you can see the examiner gives 0 there. You can see the examiner gave 0. Haya, safari tunaendelea kwa karibu kumalizia hiyo swali. The last one the examiner wants us to break down is the labor efficiency. Labor efficiency variance. Labor efficiency variance. So for the labor efficiency, we will start with the standard hours. Standard hours minus actual hours. Hii ukifungia kwa brackets, you multiply by standard rate. That should give you the planning. That should give you the planning. The standard minus the, oh, sorry. Only conventional. We are supposed to use the expected. We are supposed to use the expected. We are supposed to use the expected. Ukiweka actual imerudi conventional. So the standard hours were what was in the budget. 2,400. The expected is needed to compute Was it 1848 or 1828? 1828. And the standard rate tulikuwa na 700. So give me that. $400,000, 400 favorable. Let us go to the next one, expected hours. We now minus the actual hours. You multiply by standard rate, and that now should give us the efficiency. So the expected hours are 1828. The actual, according to the question, they were 1950. 1950. Standard rates, we already know it is again 700. You already know it is 700. $85,400 advance. So that now, finally, I will come and say, I know that if I take planning, niongezee efficiency, it should give me what we call conventional. Conventional ile ya kawaida. So this 400 favorable plus 85,400 adverse should be equal to what? Is it 3 or 2? 315,000. Favorable. Yes, 315. So you can see, and that is the one that is given there. So are we okay with that? If we are okay, say my yes. Yes, Ibrahim, Timothy, Josephine. Jeru. So I want us to correct a lesson at that juncture so that I'm able to take a few minutes. Take a cup of tea. Then I'll be back at 11. We proceed up to 1. So you use the same link to log in at 11. We pick up from there up to 1. Thank you.